What do Walmart stock in 1980, Apple stock in 2004, and Nvidia stock in 2016 all have in common? All three stocks formed the same chart pattern before climbing to new heights in their heyday. This key pattern is called a cup with handle base, and by learning to spot this pattern when it's forming, you too could get in early on the next batch of major movers. The cup with handle base got its name from the look of its chart action, which closely resembles a teacup, but to be a proper base, it also has to fit a few criteria. The stock should run up at least 30% before forming this particular base, and then it should start selling off. That decline could be anywhere from 15 to 30% from the stock's high. Eventually, the stock finds a bottom or floor of support before climbing again. That happens when fund managers or other institutional investors stop selling their shares and shift back into buying mode, picking up shares and sending the stock higher. From there, a handle starts to form. A proper handle starts forming in the upper half of the base and is at least 5 trading days long, typically in light volume. So why is all of this selling off important? Well, it means that less committed shareholders are being shaken out of the stock. Investors who may have bought at the end of the prior uptrend are now just happy to cut their losses and break even. Once those less committed investors are out, the stock has room to run. The shares encounter resistance as they form a handle, and this testing ground is where we'll be able to calculate a new buy point. Assuming that the stock keeps climbing higher, that buy point is the high point of the handle. The buy range extends 5% above the original buy point, but it's best to get in as close as possible to the entry price. A cup with handle should be at least 7 weeks long for it to count. Occasionally, you'll see them form in as short as 6 weeks. In 2016, Nvidia formed a picture-perfect cup with handle base. Between January and March of 2016, the chipmaker pulled back roughly 27% before finding support at the 40-week line. It then worked on the right side of the base pattern. A handle then formed with a 6% depth in lighter volume. Shares broke out the week ended March 18th, and Nvidia surged over 600% in just 2 years. The stock also formed additional bases along the way and offered fresh entry points for new investors. Let's take a look at a more recent example of a cup with handle base. This example is a little less picture perfect, but it's important to see all the ways these patterns can develop. Mediterranean fast casual restaurant chain Cava started forming a cup with handle base all the way back in July 2023. Shares cratered 50% before forming the right side of the cup. It's important to note in this example that the base is particularly deep. Again, the ideal maximum depth is 30%, but sometimes a deeper pullback can still work, especially for a new stock with strong fundamentals and a compelling story. The 25-week cup with handle is also a peculiar case because the handle only took 1 week to form. Typically, with a longer base, the handle will also be a little bit longer. A short 1 week handle makes it hard to recognize on a weekly chart, but during the week ended January 26, 2024, the stock made a pullback, which touched off support at the 21-day exponential moving average. This offered investors a buy point at 48.69. As you can see, volume in the handle was lighter compared with the volume in the right side of the cup base. During the week of February 2nd, shares broke out past the entry. After 3 strong up weeks, the stock then pulled back to test support at the 10-week line. This was also a pullback to the initial buy point. From there, shares pushed higher, reaching a high of 71.50 before pulling back once again to the 10-week line. Soon after, the stock took off before reaching a high of 98.69 and pulling back in a downside reversal that saw the stock closing below the 10-week line in above average volume. From the 48.69 buy point through the high of 71.50, shares gained over 46%, and in the months following, shares reached highs of over $120 per share. That's an increase of nearly 150%. Whether it's a picture-perfect setup or one with a few flaws, what these two examples have in common beyond the fact that they formed the same chart pattern is that they both had innovative products and compelling stories at the time that they made their big moves. Of course, not every stock will be a big winner, but recognizing these chart patterns is crucial to learning when certain stocks may be on the cusp of making a major upward move.